I think we are officially recording now. It's May 28th, 2026. I'm Tim Quast with Market Structure Edge. Thank you for being here for our live group discussion. And if you would just mute yourself while we speak, but please, interrupt us. There are only two rules: ask us questions and maybe mute yourself while we're running through the things that we have to cover. So I will go first. We try to swap in and out, and Brian Wilson, market strategist, will follow up. So I'll tell there are three things on my list to cover, and if you have things that you want to ask right now, fire away. If you've got burning questions, please interrupt me before I get going. The first topic I'm going to share my desktop to do that. Bear with me here. Is we all have, and I'm certainly probably chief among them, confirmation biases. I will say I've been very happy as ever that our data, they work well. They tell us when the market is likely to recover. I mean, if you look across your dashboard and go, oh, pretty good chance things rise, right? You can see the demand supply divergences. If you don't know what that is, I'll explain it. If you're new to doing this, you veterans know that's what we look at: demand and supply. We want to, generally speaking, there are exceptions, but generally when demand is rising and supply is falling, that creates, the probability that prices appreciate. And it's a great near-term thing to use. What has appreciated like some kind of, freak show, which, look, we've taken advantage of it too. There's no question. Our model portfolio has done a very good job of picking up semiconductors and getting in and out of them. It's mathematical, and it's, the math can change every day and you can be in and out of things. It's the nature of math. Could we smooth that math and slow it down? Yeah, but it changes the outcome. So, for now, this is what we're going to do. So I wanted to go to this and comment about this because, it's my confirmation bias is that instead of just speaking all the time about what an amazing run it is to also put it in context, because I think, some common sense has to be applied to it. Here's where we are. So looking at the stocks, we went from 10 to we bottomed at 5, and there's a little uptick. Supply has generally trended down. We're going to have to watch that trend. Is this an end to the run? Well, I don't know. Clearly, they continue. Here's my overarching comment on this. I read a lot of things. I have my whole regimen that I find in New York Times, Wall Street Journal, Bloomberg, all kinds of other things. There's Morningstar stuff that I read every day. There are all kinds of things. And what I find fascinating is that we seem to lack the capability to say, this is not normal behavior. And it should be a cautionary thing. And I feel like the pundits are in some ways irresponsible about this. That you look at it, this is the biggest rally semiconductors have ever had. Now, underpinning it are some very good things. It's not NVIDIA's fault any more than it would. And when I say fault, there's a negative connotation, and I'm going somewhere with that. It was not the fault of the suppliers of horses to the people who were digging canals when we thought canals were the great thing that would change everything, and they did. It was those were technological advances. It was the people building the canals. It's not the fault of the people producing rails for the railroad industry that got overbuilt, nor was it, the problem of the suppliers of fiber optic cable to the folks who were building this massive internet backbone. I was an investor relations professional then, the head of investor relations for a telecom, and we were using we did not use level 3 for backhaul, but we're using that backbone for purposes. It wasn't the fault of the people who were supplying the components any more than it's the fault of NVIDIA supplying the components to people who have this grand view of what the data requirements are going to be. All of it may be true. That's not the point. The point is that when there are extreme outliers, they should be treated as extreme outliers. And that's the way I look at it. It's why as I wrote, I rejiggered one of my IRAs because I think, and I'm not trying to time that. I'm just looking at it and saying, well, I don't want to have excess exposure to a mania. It just lacks common sense to do that. So I'm shifted heavily bonds have devalued. So, well, I'm going to put more there. And here, this has been principally driven by a very narrow set of stocks. And when that condition exists, it is exactly what it looks to be. It is overdone. Now it could go on and on and on, but I just think that that's important to realize. And look, you're not going to miss out. It's just if it defies common sense, it's probably a good idea to be more cautious. You could look at the mega caps, and as I mentioned, not to be, I don't want to beat this dead horse to death, but you could take, the 20 largest by market cap and add them up. Well, it's 41 trillion dollars. That's 27. That is the equivalent of, say, you have $1 worth of capital and you decide I'm going to lever that 100 to 1, and which is awesome as long as it goes up. Now, if from your starting point, the value of what you have goes down $1, you're out of capital and you have to liquidate. And so these things are troublesome to me because of that. It's not the amount of spending. I'm not concerned about that. I mean, it's not a multiples issue. It is the fact that of all the thousands and 4,700 ETFs and the 3 million global index products and thousands of money managers, they're all exposed to 20 stocks. And that if those things went down uniformly, everyone would run out of capital and the market would have to liquidate. And those things concern me. So that's why, I think it has to be expressed that there is danger in that. And so we think about that. I look at the broad, now that's number one, right? So I just want to express that. It's not anyone's fault, but we have to be wise and look at it and say, well, if all of the money is in 140 stocks and 60% of it is in 20 of them, probably that has the risk of an over-leveraged market in the same way that any other instance or manifestation of leverage, it's a different way of describing it, does. Okay, so not that I'm sitting around worrying, but I have taken some steps because I think that that's risky. Number two, model portfolio. So I get a lot of questions about this. It's not right here, but I'm going to just answer the question. So the model portfolio, which continues to do very well, it's up close to 49% year to date. I mean, we had great performance from our model portfolios last year. And when that performance stopped, it was a good indication of the end of that run. And we'll watch the same thing here. The difference in the models this time is we're heavily focused on this behavior, passive money. Why? Well, there's pretty simple. You can look at the Morningstar data for April. You look at the active funds, and they had net outflows of 34 billion in April. Passive funds had inflows of 76 billion. Okay, well, that's what you got to follow, right? They're the buyers. As Mike Green says, if money flows into passive funds, they buy things. Period. End of story. Whereas if money flows into active managers, they look around to try to find some reasonable multiple, right? to invest in. It's a different kind of behavior. And so, that comes with risk, but we're watching where that money goes. So how do you get in and out? Because the data that we're going to use for our decisions, when do you buy and sell? I touched on this last week. What I like to do is if broad sentiment is rising, as it is now, it's taken a turn up, and supply, at some point, this is now 20 days. I thought it had bottomed yesterday, and instead it took another leg down. So we'll see, but that's 20 days. It's a very long run. It's abnormal. It's twice as large as the normal decline on the supply side, but whatever. Okay, so follow me here. Demand rising, then I tend to it kind of makes logical sense. You buy early, so maybe the opening auction, buy in the opening. You can put that trade in and forget about it. Just put an order in to buy at the opening auction, and then sell into the closing auction. And why would you do that? Well, the probability is the market rises. So you want to get the better price when you buy and the better price when you sell. And then conversely, if generally, this is a weird period, right? Generally, if the broad sentiment is declining, you would do the opposite, right? So you would sell early in the day, expecting maybe that's the better price, and buy into market on close or something like that. It's just a way to think about it so you don't have to watch the screens. The beautiful thing about the model portfolio is it's using the math to do all the things that we do here and to take the work out of it so you don't have to sit and watch screens. Because I don't sit and watch screens. Just do stuff on if there are opportunities, if I'm focused on daily trading ideas, late in the day is when I like to buy. And if if the gain is there at the open, I'm out so that I can move on to other things. Doesn't always work that way, but several of you have sent me notes about how good those daily trading ideas have been. I mean, they do produce returns, and it's really nice to take the work out of it. So that's my comment on it. And look, there are mismatches. There are times when we'll get like Micron. What do you do if Micron goes up 20%? And then today it's in the model portfolio. You could say, well, what do you do? Right? Well, I tend to just follow the model. It's probably going to get rid of it pretty quickly anyway, which I think it did. Right? So, it doesn't really matter where you bought, it's just where you sold. Will it, in the short run, create disconnects between the performance of the model and your performance? Yes, but over the long run, there should be mean reversion. That's the notion. Okay, finally. And Brian, this might dovetail. So my last observation is, well, what happens in the first part of June? I mean, if you were looking at this, you want to project forward, what is likely to occur? We know how long these cycles tend to run. The demand, the average, demand supply cycle is, I'm just oversimplifying, 10 days. Like it goes down for 10 days and up for 10 days, down for 10 days, up for 10 days. It could be 8, if you you can run that data. You can run this, pick your period of time and you can analyze it and see what that shows you. It's pretty simple to see that tends to be what it is. We've had very elongated cycles here I'm going to go back year to date, and it's unusual. So I would not extrapolate what has been occurring since February options expirations. Of course, the Iran war was the 27th. And you have this huge run, also 20 days on the supply side. And then everybody adjusts their risk models. And then the risk models reverse. And we have this huge decline on the supply side. Are we going to duplicate that? Highly unlikely. It's as big an outlier as sort of like the SOX is. So I would expect a mean reversion, probably a much shorter cycle. Maybe it's 8 days. Well, if you could extrapolate that, you probably do get a new month, by which we mean, if you're, again, you're contributing money to a 401k that gets deployed. When you do it, may be different from when it gets deployed, but it's generally getting deployed early in the month. And so that money comes in and you get a benefit from that. And you can see it, if you have a demand supply divergence heading into the first part of the month, probably we get that benefit. The wild card is month-end options expirations tomorrow. I mean, it's not just tomorrow, it's here around it. And I feel like those adjustments have not been made. I feel like funds have not squared the books. Does that mean that they're going to do it? Because I can see it, right? You can see patterns of behavior, and it's just not there. And so it's probable that we get a reversal of this, and if funds make their adjustments, it could alter the outcome. We'll see. And that leads into what's next, and I'll hand the baton to you, Brian, and we can maybe cover that briefly together at the end. So over to you.
Thank you, Jim. Maybe you can take a peek at Brad's question while I get started.
Yeah, absolutely.
Good to see everybody. Always thankful to be with you guys. Wanted to, let's see, Dan, let's go ahead and take a look at that question before I get started. Uh, let's see. Review Cassie. All right, let's take a look at that, Dan. And I think I need to share my screen, don't I?
Brad, I look forward to answering that question. I'll come back to you. That's good. I, I think the same things. It's interesting. Sorry, Brad.
No, you're fine. So taking a look at Casey's General Store, what's the what's the setup, right now? Well, it's a setup where there is weak supply, weak demand here in green, and then supply that's moving lower. In general terms, I'm waiting for demand to pick up to buy, this type of stock. So I'm when I see both going in the same direction, I'm looking for a pickup in demand. Sometimes when demand is weak like this, you can have a stock that just stays weak for a period of time. So that would be my observation about Casey. Just waiting for that pickup in demand. Did want to touch base on daily trading ideas. Tim mentioned it already. Great way to trade. I do this every day. I just drop the names into a portfolio. You know, take a look at it a couple of times during the day. I'm not closely watching it, but I'll give you an idea. Yesterday, towards the end of the day, I looked at my portfolio and I saw that Datadog was down. It was down about 2%, something like that. And just as a reminder, when you're looking at these daily names, what you're looking to do is to enter between the entry low and the entry high. Datadog was right there. I picked it up with about 2 or 3 minutes to go in the day, and it doesn't always happen this way, but I made 5% on that name within 10 minutes after the closing bell. Like I said, it doesn't always work that way, but it was up after the close, and I sold it, and that's exactly what you do want to do. If you look at these daily names and you see a name like Burlington down 10% today, like, okay, well, that's well below the daily lows, right? Should I buy that one? Usually not. Usually there's a reason why a name like that would be lower. Just take a quick peek, and you can see that with Burlington, uh, they had earnings. So it's down off of earnings. It's usually not something that you want to mess around with. But just as a quick review, just check those entry lows, entry highs, and I usually follow a similar pattern to Tim, where I will enter into those names towards the latter part of the day. In terms of the passive portfolio, just to give you another option, and I will sometimes do this. Uh, you can pick and choose. If you don't want to buy every single name in the portfolio, recognize that you won't track the portfolio exactly the same. But if you're not comfortable buying an energy name, for example, like, oh, there's too much news out there right now, or you're not comfortable buying a semi name. Once again, you can pick and choose a little bit. I will do that occasionally, but the portfolio, as Tim has mentioned, up 48, 49%. It has done tremendously well, during the course here of this particular year. When I look across my dashboard right now, what stands out to me is just a lot of divergence. You can see it developing in the all equity portfolio. You can see it developing in the Dow Jones. You look at large cap, you see it there. Not quite there for my Magnificent Seven, but it's close. Mega cap is doing well. You come down to some of the individual sectors. Communication services doing great. Communication, consumer discretionary doing great. Even consumer staples starting to get a little bit of divergence. And you look across these different sectors. There's financials, even though they've been lagging a little bit, starting to get some divergence there. Look at the big companies for the financials. Huge short covering with recent trading. So the point is that that divergence is developing, and it's really developing, across the market at this particular time. Those that know me are familiar with the concept that I like to track both the broad market and big tech at the same time. And if both of them are leaning the same way, that's usually a pretty good signal for me. So what is big tech doing at this particular time? Well, big tech has recently bottomed, just starting to move a little bit higher. And if you've been following some of the big tech names during the last few days, that they've been floundering a little bit, essentially doing exactly what sentiment has been describing. Broad market's been doing well, but as Tim has mentioned, it's been a very narrow rally. Construed mainly by what's been going on in the semis. So big tech starting to turn a little bit, which tracks exactly what is occurring from a broad market perspective. So as I look ahead, I see that alignment with big tech and the broad market. I see a lot of divergence out there. You look at the potential for new month, new money, and Tim mentioned that earlier. But if you look at recent trading, and let's back this up to like a year-to-date basis, it's been working. Earlier in the year, it wasn't working as well. You look at February, was a more difficult time for the market, wasn't working there. It started to work at the end of March when we started to bounce. April, just a brief move lower, then started to move higher again. I've been seeing this type of pattern a lot with new month, new money. You get a brief move one way or the other, and then you kind of resume let's call it the normal trajectory. And right now, that normal trajectory, in my opinion, would continue to point higher. I'm looking at that alignment with big tech and sentiment. I'm looking at the divergence that's out there. And yeah, everything is looking pretty good. And, one thing, as Tim mentioned, to watch out for is just those month-end considerations.
Yeah, concur. Brian, am I interrupting you? If I'm not, then let me get to Andy. Let's look at Carr, Avis, right? Yeah, and then Brad. Let's come back to your money supply question. I mean, it's a great macroeconomic question. So let me share. By the way, so I had this up, and before I answer your question, Andy. I get this question all the time about the model portfolio. How is it that you could have demand and supply that are not necessarily diverging when you look at it? Like you could have demand declining, and yet somehow it shows up in the portfolio. It's because it's looking for a 3 standard deviation spread between supply and demand. So, if I run this where I have mega caps with standard deviation of 3, what I get, and interestingly, Apple is in the portfolio today. Bristol Myers Squibb is in the portfolio today. Costco is in there. And what we'll see, I'm pointing out, passive money is the lead behavior, and there's a 3 standard deviation spread. It's going to pick that stuff up. So I think also Microsoft is in there. NVIDIA is in there. NVIDIA is it's become NVIDIA's the market. In a sense, I mean, 3% volatility. That is the volatility of the S&P 500. Passive money leads. It's got a 3 standard deviation spread between demand and supply. That could change tomorrow, and all of them could be out. But that's what we're doing. And why would we do that? Well, if passive money is the lead behavior, and there's a gap between demand and supply, there's a probability of appreciation until it goes negative. And that's an exit sign. We can do one or the other. Passive money's no longer leading, or demand turns negative. Okay, so Andy, to your question, car, which is fascinating, right? I mean, it really is fascinating to see what happened here. So look at this. So now on the demand side, that's not price. Price is this. So price is 165, and then demand is comports with this graph, but it's back over 5. Supply is an astonishing 76% of the volume. That means that most of the trading that is occurring is on stock that does not exist. If you buy it at the market between the bid and the offer, your trade's going to get filled up to a certain amount, but where did it come from? Well, it didn't come from the hedge funds that own it. They're not sellers. So it's an exemption. It's a Reg SHO Rule 203 exemption from short locate rules that market makers enjoy to do that. So what does that mean? Well, it's certainly not a condition where you're wondering, is this about to become a meme stock again? I mean, you don't know. What would do it? Well, you get this extreme run in price when you have pounding demand and a decline in that excess supply. That's really what produces it. And then, of course, everybody covers and the thing begins again. I don't know. What you really look for these meme stocks is this. There's that short-term burst, an explosion in excess liquidity. That got up to 83% there. And then it comes down. And somewhere in that process, I don't know at exactly what juncture, what I pointed out to people is when this started bottoming right here and ticked up, that was the tell that it's probably over. Are these conditions extant again? I don't see them. Now, maybe the pattern we don't have the right period of time, but there you go. I don't know if I answered the question. And then Brad, to wrap up, your question, well, actually here, I'll share my screen one more time, and this will be the last thing, because I could show you. I looked this up really quickly. You can look at the M2 money supply at St. Louis Fed. It's you can go look. And so what you read in that blog is this. So you've seen, the money supply, the M2 money supply continue to rise. It is now almost 23 trillion. And it topped out, during the pandemic. It's just, that's why the dollar isn't strengthening. And then you go, well, why is that occurring? Well, I don't know the exact answer, but I can look at the Fed's balance sheet and see this. So if you look at their reverse repos, this number used to be about 1.5 trillion. It's an astonishing number. And so reverse repos are like the Fed sells securities for cash to banks. And that cash then reduces the supply in circulation and the capacity of banks to use fractional reserve lending to expand it. So that's contractionary. But that's all reversed. And so I think that that's part of it. And of course, the balance sheet has stopped shrinking. You can just look at it and go, well, it's not coming down. It's, if you backed up to 1 year ago, the balance sheet is actually $24 billion larger. That's 6.8, right? So it's now, what's Kevin Warsh going to do? I don't know. But yeah, so to your question then, does that then drive, your question is, does a devaluing dollar, because that's what it will be, is it always offset by appreciating risk assets? It's the whole Ron Barron thesis. I exchange depreciating assets called dollars for appreciating stocks called Tesla. So it's a pretty good strategy until it stops working. I don't know at what point that stops working. It happened to Japan. Japan reached an inflection point where devaluing the currency didn't work. I don't know. And now they've had another great swell of currency devaluation and a tremendous corresponding rise in their equity market against a declining population. Their GDP is shrinking. All the factors that you say, well, it's the opposite of what should occur, but that does occur. And at some point it stops working. I don't know. I don't know what to tell you, Brad, but it is the basis for modern investing. you're you're trying to offset the decline in the purchasing power of money with the appreciation of risk assets like stocks and bonds and real estate and so on. And I don't know. I can tell you why it's occurring. I can't tell you when it stops. Okay, that's enough to drive everyone to drinking, and somewhere it's happy hour. So we will we will wrap up there, and we'll see you next week. Thank you very much.